again, my name is Dale Siegel. I own Circle Mortgage Corporation. I'm in Harrison, New York, taking a cough drop. Excuse me. I have been in the industry for over 25 years. I'm an attorney, and I'm going to mute for 1 second. Forgive me. I have the end of a cough. So yeah, rates have gone up in the last 2 years. As we know, rates have gone down considerably. I'm going to mute for 1 second. Sorry. Sorry. Anyway, so yeah, since COVID, unfortunately, rates have gone down and down and down. And just after January of this year, they've gone up. The scary thing is they've gone up almost double in a period of 3 months. So it's been a big change. People are scrambling. Refis are down, as I'm sure everybody knows. And things have changed, but I can't think I'm coughing. Anyway, so this seminar, the new rules for mortgages, I like to go through 10 tips. These 10 tips are for 2022. Every year I do, typically with judicial, thank you very much, I do 10 tips for that year. Things change constantly in the mortgage industry, and I think it's important that the professionals involved know what's going on from their point of view and from their client's point of view. So, the number one, loan amounts have increased. I attached, if you have the handouts, I attached a document from Fannie Mae. Fannie and Freddie are basically the same. So when I refer to Fannie, it means that this also includes Freddie. So you can see that the loan amounts have increased from last year, about 300,000 or more for the conforming rates and the high balance conforming. So let me go back. For Fannie and Freddie, you have 2 blocks. You have a conforming loan amount and you have a high balance conforming loan amount. These 2 types of loans are bought by Fannie and Freddie, bought and serviced by Fannie and Freddie. Anything over the high balance conforming loan limit becomes a jumbo loan, which I'll discuss later. But just here, you can see that the conforming loan limits jumped from 2021 of 647,000 to 970. Okay. The high balance conforming jumped from 647 to 970. So last year, the highest loan you could get with a Fannie or Freddie product was about 725. This year, the highest loan amount is about 970. In most people's eyes, that was a jumbo loan amount. So the good thing is more people in our area specifically, and also the West Coast, California, can get higher loan amounts in conforming products, which means that their guidelines are easier than jumbo loans. Their interest rates will typically be the conforming and the high balance conforming, which in most cases are lower than jumbo interest rates, but sometimes the jumbo rates are lower, which I'm also going to touch on later. But I thought it was important that you knew that the conforming loan amounts have changed. Now, why do they change them? They change them every year. It's based on the average percentage of the increase of home prices, all right? They are based on the percentage. So what they do is the government agency, Federal Housing Finance Agency, does an analysis in November of every calendar year based on the home prices throughout that year. If they've increased, let's say they increased 3%, they'll increase the loan limits by 3% accordingly. If they don't increase, or if they go down the home prices, they won't lower the loan limits, but they'll leave them the same or they'll increase them very slightly. So if you look at the historical nature of this, they've increased a teeny bit or a lot over the past 20, 30 years. I forget when it started, but it does increase every year. They do look at it every year. This past year, as you know, home prices have gone up. They've shot up. And that's why the loan amounts have gone up considerably, because it's based on a percentage by percentage. So the increase this year, I would say, is almost like a false increase. We don't know what home prices are going to do in 22 or even 23. Of course, all the predictions are out that the prices will be falling soon, maybe Q3 or Q4 of this year. We'll see them leveling off and possibly going down, and then we don't know what happens after that. So you have the chart for the home prices, and this means that if your clients are going for, let's say, an $800,000 mortgage, they're probably going conforming, which means that their guidelines are going to be based on Fannie and Freddie guidelines. Now, let me digress. Fannie and Freddie are the largest purchasers, Fannie first, then Freddie, are the largest purchasers of mortgages here in the States, right? They set the guidelines. So Fannie has their own guidelines. Freddie Mac has their set of guidelines. Each lender creates a contract directly with Fannie and Freddie. So Bank of America has a contract with Fannie Mae. Bank of America has a contract with Freddie Mac. They create their own contract, but within their contract, they have the guidelines, the base guidelines for Fannie and Freddie, and then they have what's called overlays. So Chase may have a set of guidelines that are an overlay with Fannie, and Bank of America may have a different set of guideline overlays. So your client can go to Chase and get approved for a loan that's being sold to Fannie, but if they go to Bank of America, they can't get approved because Bank of America will have a different set of guidelines. These are overlays. This is where it's very important where your client goes for a mortgage. If they're easy, A plus credit, perfect salaried income and all that, if they're the perfect vanilla buyer, we'll call them, then they can probably get a mortgage anywhere. But if they have some issues, credit issues, self-employed people are always an issue. Their assets are all over the place, or their assets are coming from different places, then the client really needs to know where they're going. They need to understand the bank. The loan officer that they're dealing with also needs to understand the client's situation and if they can get them a loan or not, because you don't want to be stuck halfway through without a mortgage commitment letter. We're going to talk about that afterwards. So loan amounts have increased, we attach that. Now, as far as qualifying for mortgages, over the past 2 years, because of COVID, there's been very little face-to-face with people. So the lenders have stepped up their technology, which is a good thing. And this technology is staying with us, and it's also going to progress and get better and better as we go along. So as you know, the best example is nobody's at a closing anymore, which I like. I'm sure a lot of you like it too, that there's less people in the room having a conversation with you. But from the background, from the lender qualifying, okay, the lender has stepped up their technology. their process is much faster and cleaner, and borrowers can provide a lot of the information and documentation in the very beginning, upfront, to expedite this. The best example is the banks have all been using, not all the banks, but a lot of them have been using automated system to verify both income and assets. And I find this very interesting because some of the banks I deal with for income, let's say it's a salaried employee, I don't even need to upload pay stubs. We used to have to upload 30 days of pay stubs, last 2 years of W-2s, and then get a written verification of employment. At this point, we key in the information. Most importantly would be name and address of employer. Start date is very important. A lot of people don't include the start date, so we have to run after them for that. The bank will key this information into a database, and a verification of employment comes out of the database. If any of you have heard of the work number was the first automated income verification, employment verification system out there. There's a couple others that a lot of the banks have just used. They've incorporated into their own system. So it makes it very easy. Less documentation, immediate. I can upload a file and immediately I get an employment verification. If I get an automated employment verification, the bank will not do a verbal verification of employment, meaning whatever information they got out of their own database, that's what they use. So that's great. If the client has self-employed income, the bank will require last 2 years' tax returns still, but they will also go to the IRS directly and get tax transcripts, verify it. They may ask for additional information for that. So again, very fast and automated. Asset information. It used to be we would have to give 60 days, 2 bank statements, 2 months worth of bank statements, all pages, even if the last page, if it doesn't say anything, quarterly retirement accounts, all pages, even if it's 200 pages, we would have to give all this information. The underwriter would go through it. They'd be looking for interesting line items, maybe an expense that for a debt that wasn't reported on the credit report or on the loan application. Maybe they would see large deposits. Now, because it's automated, name and address of the bank, account number, full account number, and what type of account it is, the bank can do an automated verification of deposits, which means that the underwriter isn't looking at the statement and they're not going to see certain large deposits or movement, and they're not going to ask for additional information. So this is good. And this is also bad because it's not going to red flag anything that maybe the bank should be asking for. Both of these things are used to qualify. However, that doesn't mean that the underwriter cannot go back and say, I would like to get a verification of employment to break down the client's income. If they get base and bonus, maybe some commission, the underwriter will ask for additional stuff. If they're using bank accounts from multiple different accounts, an account that's outside of the United States, that money's been transferred in, trusts, other accounts, of course, the underwriter is going to ask for additional information. So the client needs to be ready for this. So point being, faster, more automated, less paper, which is good. Okay. So with that, this creates speed. Speed is good, but speed is bad because when this process goes really fast, realtors want to close, sellers want to waive mortgage contingencies or give you 2 weeks to get it, stuff like that. So these are things that we're going to discuss later that you need to discuss with your client. All right, another thing got really fast during COVID, appraisals. Last time I did this seminar with Judicial, it was probably in January or February of 21. Fannie and Freddie allowed drive-by appraisals during COVID because nobody wanted the appraiser or somebody to physically go into their house because of COVID. So they found a workaround and they did a drive-by. A drive-by is literally that. The appraiser drives by the house, takes a picture of the subject property, will drive to the comps, takes pictures of those, and provides their report, okay? This became the norm. All we had to do was notify the appraisal company that the client did not want anybody to enter, okay? With that, Fannie and Freddie decided that because a lot of people didn't want to go in, they went back into their databases and they realized that they had most of the information for these appraisals within their own databases. If somebody had purchased the house within 10 years of selling it or within 10 years of doing a refi, Fannie and Freddie could go back in, get that appraisal, get the floor plans, get all the pertinent information that doesn't really change, and use that. Then the appraiser would simply have to go out, update the comps, provide outside pictures, and they would accept that. Then to take that further, they started waiving the appraisals. They would waive the appraisal if they had it in their database within, let's say, 5 years. And they would also require a certain type of mortgage. So they would waive an appraisal if the client was buying a single family home, primary residence, putting down more than 20%, and it was an A-paper deal. Okay, they felt that the risk was not that great, and they said, we don't even need an appraisal. This would be for a purchase, and this would also be for a refi, only rate and term, not cash out. If it was cash out, they'd want a full appraisal, which would also include a drive-by. Now, okay, last couple of months, appraisers are now allowed, or banks are now allowing to do what's called a desk review, okay? A desk review is not even a drive-by. A desk review is, I gave you the requirements in a little bit of a handout, and again, it's an A-paper loan. A desk review can only be used for purchase of a one-unit, properties a single family. Now they increase the LTVs to 90%, right? And the appraiser needs to have a computer-generated floor plan, which means that they get the computer-generated floor plan from either the town, the county, wherever the building records would be. People may have it. We can get it from a realtor. We can get it from the current owner. So they now allow these desk reviews. So you, as an attorney, if you're representing a buyer, your buyer is going to be pushed to waive an appraisal, right? From a realtor, because the market's crazy, crazy, hot, hot. Everybody's waiving their appraisals. When my clients ask me, should I waive the appraisal? I always say, ask your attorney. Because I don't want to be the one to tell them, waive it. And then if I have to get an appraisal, or if I do the loan and the loan comes back and it says, you need an appraisal, a full appraisal, and they waived it, they obviously still have the right to order the appraisal and go into the house to do the appraisal. But now the seller's going to be like, well, you waived your right to do the appraisal. Why are you even coming in? Because they need it for the loan. So you're going to discuss that with your client, but I will have choices for the client. Full appraisal, drive-by, or desk review, okay? A desk review is obviously the easiest and least intrusive manner to get an appraisal. It's also the fastest way. But again, it's a choice that the client has to make. And even if the loan has been approved with an appraisal waiver or a desk review, that doesn't mean that the client can't say, we want to go in and do a full appraisal, because we can order it for them. We just need to notify the bank that we're ordering a full appraisal. Once we order the full appraisal, we're obligated to use the full appraisal. So appraisal, to conclude, becomes a big discussion with the client because it's become a big issue. All right, that's number 3. Number 4, the 4th tip I have for you, credit scores have gotten lower. Last year, the minimum credit score Fannie and Freddie would use is 640. This year, the minimum credit score Fannie and Freddie will accept is 620. Now, quick review, credit score, also known as a FICO score, it has a range from 450 to 850. A credit score, we do what's called a tri-merge. There's 3 credit bureaus: Experian, TransUnion, Equifax, all right? We use the middle number. We don't average it. It's not the middle in the page. It's the middle numerically. The middle number numerically is the credit score that the banks use to qualify your buyer. If there's 2 buyers, they use the lower of the 2, all right? So your credit score is really the most important part in qualifying for a mortgage. We've done seminars only on credit scores, but just within this, the credit score gets affected by so many factors, all right? It gets affected by your ability to pay, your payment history, your high balance, how many credit pieces you have. If you only have 2 trade lines, you might not even register a credit score, and the credit mix. So what's the best thing that's going to affect your credit? A mortgage, car loans, major credit cards, Visa, MasterCard, American Express doesn't always report, store credit cards, very little, and then let's just say miscellaneous. Student loans will affect your credit score, okay? So your credit score goes from a range of 450 to 850. Fannie and Freddie likes the sweet spot is about a 700. They would go down to 640. Now it's 620. FHA will go as low as a 580, which is pretty low, all right? The lower your credit score, the higher your interest rate. The lower your credit score, the lower your loan to value the lender will allow, either on a purchase or a refi, all right? So I did include a couple charts, which I think are super important. They may be small, but these charts are, if it just says Fannie, just know that it's Fannie and Freddie. If you look at the chart, which is in this packet of papers, you can see that now the credit score is as low as 620. And if you are buying a primary residence, you can do a loan to value up to 97%. 97% if your credit score is over 620. So that's creating a good amount of risk for these lenders. The higher your credit, the better your interest rate. The next page in this handout, for those of you that have it, it says conforming price adjustments. You can see these, wow, the numbers are really small. You can see that these overlays, if your credit score is between a 620 and a 639, they're going to add 1.5 points to the price of the loan, not the interest rate. So that would be if your loan to value is under 60%. If your credit score is between 620 and 639, and you're taking out a 95 LTV loan, you can get that loan, but they're going to charge you an extra 3.5% points. So 1 point equals 1% of the loan amount. So for ease of math, if you were taking out a $100,000 loan and you had a credit score of 620 and you were doing a 95 LTV loan, the bank would charge you $3,500 out of pocket in points to get this loan. Now, you can also increase the interest rate to eat up part of those fees, but the point is that it's possible, all right? Two things, just so you know, starting July 1st of this year, medical judgments will be removed from your credit report, which is really important because most people, their credit scores are negatively affected due to medical debt. So all unpaid medical debt less than $500 will not appear on a credit report, and that's individual, it's not total. So if I owe 3 doctors $300 each, none of those judgments will appear on the credit report, and therefore they will not affect my credit score. Once this passes, once this rule passes, the time frame passes, all these medical judgments will be removed from people's credit reports. And what's it going to do? It's going to increase their credit scores. So this is a good thing. Back in 2018, they removed federal tax liens, not real estate tax liens and not state tax liens, but they removed IRS tax liens from the credit report. So again, it doesn't show. It won't negatively affect your credit score, but do know that if your client does have tax liens, the banks do a third-party search to see if there's any outstanding tax liens. They also make sure, like right now, April 15th have passed. Once you file your tax return, let's assume that you didn't file an extension, you would have to show proof of e-file and proof that you paid your federal tax bill, or you're in an approved tax payment plan with the IRS. They never ask for state, they only ask for the IRS. So they want to see your taxes are filed and that you've either paid your taxes. They also want to see if you're getting a refund. They want to see if you actually got the refund. And people say, why? It's a refund because they want to, it's a double check to make sure that the taxes that were filed were not fraudulent, that they were actually reviewed by the IRS and that the refund was submitted to the client. Going back a little bit in time, 2017, they removed reporting civil judgments from credit reports, which would be if I sued you and I got a judgment against you, or your plumber sued you and got a judgment, which opened your credit report. About 5 years ago, they removed that. And again, it's no longer public record, and it does improve your credit score. So what does this mean? This means that for those of us that have been in the business for a really long time, like me, people can get mortgages that maybe shouldn't be able to get mortgages. Their credit scores are too low. They have very little equity in the property. Maybe part of that money is borrowed, which is allowed by FHA. So it's opening it up to maybe another downfall in the mortgage industry where people go into forbearance, foreclosure, and the like. But we'll see what happens. I think that now, back then, which was, I guess, in the late 80s, early 90s, people were getting mortgages and there was really no verifying of income and no verifying of assets. we're going down that same road again of offering the kind of mortgages, not we, they, and but they're doing more verification. There's more backup data. So I think that if there is a downfall, it'll be a lot less than it was because thankfully Fannie, Freddie, and the banks and the government and everybody learned from previous mistakes. And I think that people won't be, defaulting on loans like they did before, but who knows? That brings me to another beautiful product from back in the day, non-QM. A non-QM loan is a qualified mortgage. Non-QM means that this mortgage is not qualified by Fannie or Freddie. Fannie and Freddie won't buy non-QM loans. Where do they go? Portfolio lenders, Wall Street, REITs, okay? They're the ones that offer them. So remember the no income verification, no asset, no income. They were called NINAs, no income, no asset verification loans. They were bought by Wall Street. So these same mortgages are being bought by Wall Street, being bought by REITs. These kind of loans, again, they got a little bit smarter and there's more verification. There's no true no income, no asset verification loans. There's a lot more verification. The biggest one that I use that I guess a lot of people use are investor properties. These are based on rental income only. So a rental income only loan means I'm an investor, I'm buying a 4-unit home, and it can only be 1 to 4s. Anything over 4 units, 5 units and above is considered commercial, right? So I'm buying a 4-family house. I'm an investor. I don't want to show you any of my income or any of that. So they say, the bank says, all right, all we're going to do is verify that you have the down payment, the closing costs, 6 months reserves, and we are going to use solely the income, the rental income produced from this property to qualify you. So if the gross rental income on my 4-unit property is, let's just say, $10,000 a month, my principal, interest, taxes, insurance cannot be higher than $10,000 a month. So they'll go on a 1-to-1 ratio. My rental income is $10,000. My principal, interest, taxes, insurance, housing expense cannot be any greater than $10,000. Okay, and accordingly, they want to see you have landlord experience. What is landlord experience to these banks when they verify it? If I show them that I was a landlord back in 2005, and I showed them that I had a copy of a lease from a tenant of mine, that would qualify as rental experience. I can also get a letter from an accountant that'll show I have rental experience, all right? So this is a non-qualified mortgage. What does that mean for rates? Believe it or not, the rates may be 1 or 2% higher than a primary residence. So if right now you're paying 5% for a 30-year fixed primary resident, you would pay 7% on a 30-year fix for a rental income only mortgage. So they're very good products, and they're very useful for people that just don't want to or don't need to. They're like, I don't care, I'll pay the extra, the higher interest rate. I just want to show that I have the down payment, and then I know the rental income will cover it. So these are really good loans. The other loan people use, self-employed people. I think I covered this in my last seminar. If you're self-employed, I can show you the last 12 months business bank statements. The underwriter will average out the deposits into my business bank account, and they will use that as my gross income. okay? I don't need to show tax returns. I don't need to show P&Ls, nothing. Last 12 or 24 months, business bank statements, they will average the deposits. So I've had clients that say, well, I make the bulk of my money during the summer season. Even if they have a couple of months that shows zero deposits or very little, the bank will average it for the last 12 or 24 months, depending on what the program is. Again, non-qualified, they'll do these loan amounts up to $3 million for a primary residence. Condos, they typically won't do co-ops with these. So those are also very important. Last thing is an asset depletion. An asset depletion loan is where I show you I have a bank account, $2 million in the bank account. I don't show you my tax returns. They take the $2 million, they divide it by 360, the 30-year term of your mortgage, and that's your income, all right? Of course, it's not every bit of your assets, but mostly it's retirement funds. They use that. So if I have a pension or an IRA or some type of retirement, they'll take that. They will also take liquid assets and use part of that. It's a formula, but it's allowed. This is now a Fannie and Freddie product, okay? So asset depletion can be used with DU, Fannie Mae, and Freddie Mac. So sometimes it's non-QM, depending on what the product is. If it's $3 million, it's not going to be a Fannie. But if it's $750,000, it will be Fannie and Freddie, okay? So that's non-QM. It went away immediately when COVID hit. It's back now. And more lenders offer this. All right. Forbearance and modification. A lot of people went into modification agreements during COVID, okay? Or they were allowed forbearance. A lot of people took, whether it was 3 months or 6 months, they got an extension. They got their extension for 12 months, 18 months. Then they went into modification. Now they're in a modification plan. Fannie and Freddie allow, if you are in a modification plan and you show that you've made 3 timely payments, you qualify for a mortgage, okay? Refi, new purchase, has to be a rate and term refi or a purchase. They won't let you take the cash out if you're just 3 months in modification. Rates are the same. Everything's fine. You just need to prove that you made 3 timely payments for Fannie and Freddie. For FHA, it's 6 timely payments out of modification. So your client needs to show the original note, the modification agreement, and 3 timely payments. And those timely payments, incidentally, cannot be made in advance. So if you got out of your, if you finished your modification in January of 22, you would have to pay February, March, and April. You couldn't pay February, March, and April, or in February and then get a mortgage in March. They didn't allow that, okay? Forbearance, if you're in forbearance, they won't allow you to take out a new mortgage. You need to get out of the forbearance, okay? Either by moving into a modification agreement, paying for 3 months, and then selling the house or doing a refi or whatever. If you've sold your house, it's considered that the forbearance agreement is over because you sold your house, all right? So that's a good thing. Now, next thing, student loans. Student loans are a little bit different than forbearance, but a lot of mortgages, but a lot of people went into forbearance with their student loans because they could. So if you're in forbearance for your student loan, they're still going to qualify the mortgage with you making the full and actual payment. So you can be in a forbearance agreement. They're not going to make you get out of it, but they're going to calculate either based on what you were paying before or 0.5% of the total outstanding balance for Freddie and 1% of the total outstanding balance for Fannie and FHA, okay? And this is a topic where the banks will have their own overlays. So Fannie and Freddie will have their own guidance on student loans, but the banks one bank may require more than another. And also, now that they're going to allow people to have their student loans wiped away, a lot of people say, well, my student loan is going to be wiped away. Can you not include that? The only way the bank will not include the student loan payment is if A, it's been wiped away, obviously, or you have the documentation that it will be wiped away in the next, I think it's 60 days. So you need to have a letter that shows this is your student loan, this is the account number, this is the balance. It will be wiped away on, let's just say, May 15th, okay? Then the bank won't include it in qualifying you. And again, each bank is a little different. Getting student loans wiped away or forgiven is a little, not dicey now, but it's a little still up in the air because some people have, some people haven't, some people still don't know. So they don't want to pay off or pay down their student loans to qualify because they're hoping it'll be forgiven. And I can't fault them with that, right? So that's
Can we give the course code?
Yeah, it is mortgage 2022.
Thank you.
All right, I'm just going to wrap this up, Diane, and then we'll save a little time for questions. All right, so the last 7 things I touched on are qualifying real mortgage, rules and regulations. Again, each bank is going to be a little bit different. So with that, it depends on where your client goes for a mortgage. So you should be aware of if your client is going to Wells Fargo or if they're going to some obscure credit union in Tennessee. We're in New York's a different animal, especially with condos and co-ops. So you always want your client to go to a good lender. You want your clients to have be aware and have a good relationship with the loan officer. And you also want to be mindful of where they are in the process, especially if you know they have certain issues. Self-employed, not really an issue, but creates more documentation. If they're going for a non-qualified mortgage, you want to be aware. You want to be aware of, and you want your client to be aware and the loan officer to be aware of your mortgage contingency dates, closing dates. You want to know what kind of appraisal they're going for, when the appraisal is done, if the appraisal came in, if it came in at contract price. So you have to be aware of a little bit more of what's going on in the mortgage process, I think, because the mortgage process has changed through automation technology. A lot of these things have moved on the wayside. So that brings me to, should your client waive an appraisal and should your client waive the mortgage contingency clause because the realtor is telling them everybody else is doing it? I believe that's a discussion between you and the client. I always tell clients, be prepared, have your pre-approval letter, which is way more than a pre-qualification letter. It's a commitment letter with property address to be determined that will tell the client what kind of documentation they need and what their loan amount can be, their highest loan amount or close to it. But it's not going to tell the client if they can have an appraisal waived on this particular property. So I think you should be more aware of where your client is and where they're going and what they're doing. And lastly, what we need from the attorney, we need a fully executed copy of a contract, legible, please. And the new thing we need is the escrow letter. I don't always get it. Sometimes I do get it that says the letter is being held by the seller's attorney in their escrow account. Now Fannie and Freddie require that, so we need that. Last thing that's always helpful is the memorandum of sale with everybody's information in it, which includes the real estate brokers and their license numbers. So that's important because we needed to prepare the CD. So I'll stop there. Diana, if you have any questions, I'll cough and then answer anything.
We do have a few questions. So first, we do have a question. It's kind of a multi-part question about the medical judgments. Will past medical judgments be removed as well, or just going forward?
Passed.
Pass. And would a third-party search include the judgments?
I don't think the medical judgments will show, but they may show up if it becomes a lien in a title report.
Okay.
Right?
And even though credit ratings won't reflect these judgments, Experian still warns that lenders will still look to see if the buyer has any judgments. Do you think this will mean credit scores might have less value or impact on loans?
That's a good question, but in the near future, no. I think that credit scores are still one of the most important indicators. But that's a good question.
How are appraisals handled for jumbo loans where it's not a Freddie loan?
Depending on the loan size, the bank will require either 1 or 2 appraisals. And again, it'll depend on the lender you're going to for a jumbo.
On waiving appraisals, am I correct that the effect of waiving the appraisal is that the buyer cannot ask for a lower price if appraisal comes in lower than the purchase price, and cannot cancel the contract on the basis of the appraisal? Are there any other consequences?
So that's why I say discuss it with your attorney, because that's huge. I have seen that some people will waive an appraisal, but they'll put a floor on it. So they'll say, let's say the house was listed for 500, the people are paying 600, right? 100 over list, and they're waiving the appraisal. So some people will negotiate, okay, we'll waive the appraisal, but we're getting the appraisal. And if it comes in below your original list price of 500, then we can walk away from the deal.
If a borrower is getting a drive-by or a desk appraisal, do they still pay full price for the appraisal? And how does a borrower know which kind they are getting?
That's something you discuss with your loan officer, what type you're getting, because like we said, you can get a full-blown inside appraisal. It's about $75 less. So maybe it would be a normal appraisal would be $550. Maybe this will be $475. I don't think the money should be the decision, because it's not that much of a savings.
Okay. It sounds like you had mentioned that people are getting mortgages who maybe shouldn't. Do you foresee something like what happened in 2008 happening in the future?
I don't, because I believe that the banks have better technology. So I hope not.
Is it true that somebody can damage their credit if they check it a lot on their own?
Yeah, don't run. If anybody wants to run their own credit, I always say go on Credit Karma, Karma, creditkarma.com. Just do the free one. Don't do the one with the bells and whistles. You'll get your score, but don't go into any sort of subscription. It's going to kill your credit.
If it's a cash deal, and is the appraisal waived by implication?
No, you still have the right to get an appraisal even if you're paying cash.
Have you seen cryptocurrency affecting the mortgage industry at all?
No, not yet.
Sorry, just trying to.
It was a good one.
On the four-family rental income issue, do the banks apply a vacancy allowance?
No. With Fannie and Freddie, it's we take 75% of the gross rental. When you're doing non-qualified mortgage, rental income only, we take 100%.
Okay. Last one. What are the debt to incomes for conventional FHA and VA loans?
So this is where each bank would differ, but I would use a rule of thumb. Debt to income should not be any higher than 50% of your gross monthly income.
Okay.
With FHA, your housing expense cannot be higher than 87%.
Okay.
So with FHA, they'll go 47% housing expense, but they'll go up to 55, 56, 57 for your back end ratio, which is your total debt to income.
I think that was our last question. We got through those quick.
That was good. You were good.
Thank you so much for your time. Thank you everyone for coming. It's always a pleasure having you speak for us. And we hope to see you at our CLE in May.
Thank you, everybody.
Thank you.